8-month low in the month of September. And most tellingly, GST collections in September were only 6% higher year on year against a nominal GDP growth forecast for the current year at 10 to 11%. To what extent will these macros reflect in the Q2 earnings? I have with me Seshadri Sen, the head of research and strategy from Emkay Global. Seshadri, good morning, and thank you very much indeed for joining us. Well, for starters, yes, we've had two biggies who have already announced numbers and a few smaller ones. But how bad is the second
sector where there is a high base effect? And this is the last quarter of the base effect. Cement, this is a seasonally weak quarter. And this time the seasonality has been a little more pronounced than normal, which is why cement is dragging the overall Nifty and, from the Emkay coverage universe as well, down further. If you strip these two out, our coverage universe is showing about high single digit, 7% top line and 12% bottom line, which is reasonably healthy. And Nifty's, again, if you strip out these two sectors, is also showing fairly similar earnings growth. So we don't think that this will reflect majorly on the quarterly earnings. However, if this continues, then the commentary will get affected, and that could be an overhang.
Let me come to the however in just a bit. What is at the moment the full year forecast? Is Q2 a one-off and full year going to be a good middle single mid-teens, high teens kind of growth in earnings?
Yes, I think for FY25, we are still looking at a low to mid-teen. High teens is unlikely, low to mid-teen earnings growth as far as the Nifty is concerned.
Okay.
And there's nothing in these Q2 numbers which disturbs that trend. Okay. And if you analyze the Nifty EPS forecasts, they've actually been rock solid over the last 6-8 months. So I don't think that there is a risk. FY26 would, however, may be a different story, especially if there are rate cuts and banks start showing some stress.
No, fair point. Let's not venture into FY26 simply because we still have a November 5th event to tide over.
We are seeing, as a sector, we are seeing worries, though I would argue that is known in the price. I'm not sure that it'll promote a sell-off, but as far as earnings is concerned, that's one sector which we are looking at a reasonably soft quarter. That is probably the only one. Oil and gas, obviously, energy is the other one where we are expecting year-on-year growth numbers.
Which you said that energy is actually impacted by the high base. You said that. Let me come to the stronger sectors then. Consumer is again a little troubled. The DMart numbers didn't look good. And of course, you could blame it on quick commerce, but overall the numbers were not very encouraging. As well, if you looked at, the GST numbers, GST is a consumption index. That didn't look very good in September. IIP numbers, consumer non-durables, didn't look good. So would you worry about consumer staples generally, FMCG?
No. I think there is a shift in the consumer sector in FY25, and we are going to see signs of that in the second quarter results. There is a significant slowdown in discretionary consumption. So all areas of discretionary consumption, which are not staples, which are, which show some kind of top line stress. And you will see that coming through. Those are, however, some of those companies are fairly small, but I would keep an eye out on discretionary consumption. Staples, and what is happening this year is that the momentum is shifting away from discretionary to staples. Staples, after a fairly torrid 2-3 years post-COVID, is starting to show signs of recovery. So I think, some of the positive surprises could come in the staples sector, where we will see both top line and bottom line momentum. Retailers may not be the best way to look at it, but the companies themselves could show signs of recovery. Okay. So we are actually, quite the opposite of what you're saying. We are quite constructive, in terms of how staples will report. The sectors also rallied. So
but you're clearly super optimistic on consumer discretionaries.
No, I'm a little cautious on consumer discretionary and a little optimistic on consumer staples. I'm not super optimistic in this environment on anything because we're dealing with a fairly high base
Okay.
on consumption of 3 years of momentum. So one has to factor that in when one calibrates
Okay.
expectations.
Where is your area of comfort in terms of earnings? As in, where would you be optimistic at all?
See, I think industrials, auto ancillaries would all show reasonably strong earnings.
Okay.
Now, as I pointed out in my last note, that's some of that is in the price, but in terms of earning momentum, I think that is where industrials especially would continue to show. There has been a bit of a blip in the first quarter, in the first half, because government capex has slowed because of the elections and
Yes.
other factors. And maybe some of that is reflecting in the macro numbers that you just were referring
Okay.
to. But having said that, I think industrials will still show fairly strong earnings.
Okay.
Whether these valuations justify those earnings is a different debate, but earnings-wise, that should be one sector which shows
No,
strong
I'm coming
numbers.
to the prices in just a minute. It's just that they change so radically. But let me stick with performance. If for the full year, you said that, low to mid-teens growth is what you're fixing for the Nifty. What about the broader universe?
A broader universe is tough to make, beyond, say, Nifty, it is really tough for it to make a forecast for any index because as you go deeper, the extent of coverage for some of these sectors are not that
Okay.
strong. So what we do is look at a disaggregated analysis of the top 350 companies by coverage.
Okay.
And there, if you look at the broken down numbers, around 65% of the companies have their earnings in the range of +10 to -5,
Okay.
right? Which we call as stable.
Okay.
So our the key conclusion from that is that broad earnings forecasts and at a disaggregated level look very stable.
Okay.
They've been look more stable than they have for the last 2 years.
That's good news.
And that gives us comfort because aggregate numbers, are moving parts.
Sure.
One large company shows a drop off and it can get quite misleading.
Yeah, I
So
take your
this is the
point.
number.
I take your point on that. So let me come straight away to, both putting price and valuations, putting earnings and valuation together and the current price trends. Where is MK overweight?
So we are overweight on consumer discretionary, which may seem a bit odd given what I said, but there we find autos fairly constructive. We continue to like healthcare, and those are our two main overweight sectors as far as at this point in time.
Okay.
We are as I said a little cautious on the markets overall, so we aren't bullish on too many sectors at this point. Energy is the third sector that we like.
Okay. We'll leave it at that, Seshadri. It was a pleasure speaking with you. Thank you very much for preparing us for the oncoming earnings season, though, of course, a couple of biggies have already reported. Thank you very much for joining us in this discussion. Well, that's it on Bazaar.